In today's class, we will try to concentrate on the overall process or some brief guideline of managing individual and institutional portfolio. Probably you already have got some basic insights from previous classes and also from your learning from the module of investment analysis in previous year. So in first phase, we will try to concentrate on individual or private client or private investors. And in subsequent session or in following session, we will try to concentrate on institutional portfolio management. In our introductory session in this course, I try to give you a brief overview of how the portfolio is managed, process you can probably recall. So we'll try to see more detail of that process, firstly from private client perspective and from institutional client perspective. So it's an overall process that how portfolio is designed or investment portfolio is particularly planned for a particular investor or strategies are identified, and what kind of external or internal factors influence the overall portfolio management process for both type of clients. So you most probably have spent a good amount of time to learn the contents of investment policy statement in your investment analysis course, and most of the contents of investment policy statement are usually generated by having conversation or gathering information with the clients or from the clients. So in this module, rather than understanding the contents of the investment policy statement, we will try to make some rough works how to construct a real IPS for individual portfolio as individual investor. And we will also try to get some facts from the institutional IPS, though that IPS is more diverse and more sophisticated, particularly for institutional investors. So let's try to understand our subsequent concepts. However, before that, we need to have a good understanding how we can differentiate between individual or private clients and institutional clients. I think from the very first chapter or first lecture, you already have got an idea that how individual or private investors are different from institutional investors. And if I ask you whether this investor is individual investor or institutional investor, you can, I'm very confident that you can easily identify that which investor is of which type. However, in addition to knowing or identifying only whether the particular investor is individual or institutional, we are in this session will try to get some facts how these two type of investors differ from each other. So first of all, in investment market or in financial market in broad sense, investment is significantly crowded by the institutional investors. They share the dominant portion of the investment in investment market or investment industry in particular. But from the 90s decade, or specifically after 90s, the market for private clients has been growing at a significant pace. And one of the potential reasons for this significant growth is that some individuals or average individual income and wealth has been growing across the world. So compared to 100 years back or 50 years back, it has become difficult to manage own or individual portfolio by himself or herself, not only for the increase in size of wealth, but also for the reason of increasing complexities, diversity in the financial market, and availability of a wide array of investment opportunities. And in addition to that, as the complexities in financial market is growing gradually, so it is not possible for individual investors to learn all the facts and figures of the complexities or diversity in financial market. So many find it worthwhile to take the assistance or help of professional asset manager or wealth manager and assign him or her for managing the portfolio or managing the wealth of individual investor. But matter is that still now the institutional investment is dominant in the financial market in aggregate. And in institutional investors, you know very well that particularly endowment fund, pension fund, then trust, then a defined benefit plan, defined contributory plan, what we have come to know from the lecture one. These are particularly in institutional investor category or institutional client category. But matter is that, or which one is fact, that in latest statistics, it is shown that on a global basis, institutional investors represent approximately 70 trillion in investable assets in the world. However, out of this 70 trillion, more than 50% or close to 50%, or you can say 35 trillion is held by pension fund itself or pension fund category of institutional investor. So you may realize that how dominating or how crucial the pension fund is, or the role of pension fund in the overall investment industry, and on the opposite side, how important it is for the job holders across the corporate sector and the government sector, how important it is as it is growing. And if you can recall from the lecture one, out of this pension fund, not from lecture one, out of this pension fund, between defined benefit and defined contribution, this portion is taking larger share, and this portion is reducing its share. And you know very well what is the reason, as I already explained that in previous session. And another fact you need to recognize that before 90s, it was a common tendency for institutional investors only to invest in particularly safer or less riskier investment like fixed asset or government securities. However, after 90s, this pension fund, endowment, trust are trying to focus on equity market or stock market. And in very recent days, beyond the investment in equity market, they are also trying to concentrate on the investment in alternative investment market. I mean, they are trying to invest in kind of venture capital fund or the startup fund or the private equity investment, which are relatively more riskier compared to conventional stock market and the conventional financial market, and most riskier compared to the investment in government or treasury or municipal securities. So the trend of the investment in institutional investors and their portfolio composition has been gradually changing. So we have checked one of the differences in their term and in their basic profile of private and institutional client. But other than that, you need to recognize that there is a good difference between the objectives of private client and the institutional client. You can easily recognize from your personal life or from your family that what kind of objectives you pursue when you are an individual investor or you are a private investor or you are a retail investor. So you probably want something like some uh, flows or some benefits in your life, which will give you benefit like when you get retired, you need to secure some cash flows after your retirement, and you uh, from your investment analysis course, I think you already have recognized how important it is, the retirement for individual person. It is much important because it is an uncertain period of time for individual when there is no fixed flow of income as the career ends. But for this time period, individual starts to make plan when they are in the job. So this is one of the most common objectives of private client. And some other objective can be like, for example, you will have children and you want to, or your client particular, your client will has children and your client wants to uh, wants to construct a portfolio or form a separate portfolio which will give him the benefits to fund his or her children's educational expenses when they will grow. So these are kind of objectives of private clients, what they pursue. You need to be precise to understand the objective of your own client or your individual client. And in most of the cases, it is found that that their objectives are highly subjective, or it is not very easy to quantify their objective in terms of financial numbers. For example, your client wants to have a benefit or have some flow after 10 years for giving or for arranging the wedding reception of his or her daughter. Okay, so the matter is that as the inflation grows and the culture changes and the context changes, it is not very easy to objectively quantify that how much expense will be incurred by your client for the wedding reception of his or her daughter. So in that case, it is a challenge for the asset manager, or if you pursue career as asset manager, it will be a challenge for you when you can't objectively measure the objective set by the client. And compare, in addition to this example, you can also take another example. If client thinks that he will have a good amount of flow after his retirement, it is not very easy that what will be the annual expense required for your client after the retirement. So if your client has some or faces some medical issues which is uncertain, in that case the required amount of flow may go up, or if there is any unforeseen contingency, the flow required by the investor may grow, or individual client may grow up. So in this case, defining the objective and quantifying the objective in case of individual or private client is relatively difficult compared to when you deal with the institutional client. In case of institutional client, objective is more narrowed down or more precise, and it is not much difficult to quantify it objectively. For example, our department has an endowment fund. Okay, so it is a kind of, if I allow some asset manager to manage our endowment fund, in that case, for that asset manager, our department will become an institutional client for this fund, endowment fund. So for what purposes this endowment fund has been set up? For example, one kind of objective is such that every year 50 students will be given a scholarship to meet up their monthly expenses related to education. So in that case, this objective is more precise. And if you want to quantify that how much scholarship will be given, and it is not the fact that the expense may grow up in reality, but the institution will not change it rapidly or change it frequently with the changes in educational real expenses of the student. So for example, they have said that annually we will give 2000 monthly we will give 2000 taka per student. In that case, you can as asset manager, you can objectively quantify that how much flows this institutional client or endowment fund will need to have to meet up this objective. And in case of constraint, in terms of constraint, if the constraint actually varies from the individual clients and the institutional client. If you look at the individual investor, their investment horizon is mostly shorter term. Because they have a diverse number of needs, so they can't invest a significant amount of their wealth for a longer time horizon, say 15 years or 20 years. It is not very likely in case of individual investor. So if I like to give a related example that how you can understand or how can you relate that individual investor have a shorter time horizon. Uh, in mutual fund management, uh, asset manager to the asset manager, a big challenge for them is redemption of fund by the investor. So you, other than the reason for the underperformance of mutual fund, individual investors may require redemption of fund from a particular mutual fund for some immediate reason or for some regular reason. So what's the challenge for the mutual fund manager, or you can think of in this perspective for wealth manager? So if you don't have a good amount of liquidity, what is the alternative to you? Will you go for borrowing as asset manager to meet up the liquidity demand for these investors? It is not a very convenient option to go for borrowing. So which is more convenient, that is to sell off a particular portion of the portfolio you have constructed. So when you are selling off a particular portion of your fund as asset manager, in that case, your portfolio composition changes. Your portfolio profile changes. So in that case, the objective you set primarily may not be realized. So it is a particularly big challenge for the fund managers to tackle the redemption of fund. So to handle this kind of request from the investors, what fund investors usually do, sorry, not fund investors, fund managers usually do, they try to impose some regulation that, particularly not in case of closed-end mutual fund. In closed-end mutual fund, the fund manager does not face this kind of problem. In case of open-end mutual fund or open-end fund, unit fund, asset manager needs to convert their portfolio to meet up the liquidity demand of investor. If they don't have a good or adequate amount of liquidity, so they provide some restriction like you need to provide me 7-day notice, or in some fund, for example, hedge fund. In hedge fund, there's a restriction that you can't withdraw your fund for 3 years. In venture capital fund, there's a restriction that after within 5 years you can't withdraw investment. So what is the reason of imposing this kind of restriction? To restrict the investors' withdrawal of investment from the fund in a short-term period. So it is a particular challenge for you as asset manager when your client, I mean your private client, has a shorter time horizon. So in addition to this, when there is a shorter time horizon, you as an asset manager, you can easily understand that a particular investor who has a shorter time horizon, obviously he will be a kind of investor who will take less risk because of his shorter horizon, and he will have more liquidity in it. It is particularly for private client. But when you think from the perspective of institutional client, the situations are mostly just the opposite. In case of institutional fund, in many cases, it is found that the investment horizon is kind of infinite. So in that case, you don't need to be concerned of converting your portfolio or cashing out your portfolio before your expected or stipulated time period. And in case of individual investor, their investment size is relatively small or their scale is relatively small. So if it is such that they want to, you want to diversify the portfolio of private client by investing some portion of their wealth in real estate, but the amount of investment required to include this real estate in your client portfolio may not be adequate in case of individual investor, because their overall investment size is smaller. So you can't effectively diversify uh, relative to your expectation. But in case of institutional investors, it is not that much difficult. Rather, it is very much easy to diversify by investing into as many baskets as you want. But you need to satisfy the restrictions of the uh, institutional client. That institutional client, if they restrict you to invest, not to invest in particular sector or particular asset class, for example, they have restricted you not to invest in any alternative asset other than the equity, forex, and bond. In that case, you are restricted by the constraints set by your client. And in case of uh, tax constraint, there is different in there's a difference in terms of private client and institutional client. Uh, for example, in case of private client, it has been found that the investment in which the tax burden can be reduced, not the eliminated. Not you are trying to eliminate the whole tax. Rather, you are trying to reduce the tax burden. For example, as you have completed your business taxation course, you already have an understanding that between government securities or among the government securities, there are some securities in which reduced tax rate is applicable. So in that case, by investing in those securities, you are making efficiency in terms of tax in the tax payment. So in that case, tax efficient investment is more suitable for this kind of client, for private client. But in case of institutional client, it is found that the option in which you can reduce your tax burden is less favorable compared to investing in those investment in which there is a possibility of making the income as tax exempt. And in terms of governance, which has become particularly important nowadays, because most of the time, particularly in developing countries, the asset manager does not obey the restriction, the goals, objectives set by his or her client. So there is a misunderstanding between the client and the wealth manager. But nowadays, this investment governance or the importance of investment governance has grown up significantly because of improving the regulation or growing regulation for ensuring good governance across the world. So in case, however, still now, in case of private client, the governance structure is very informal or less formal. In particular, you can say that their investment policy is particularly set by the individual investor, and most of the time there is no intermediary. And if individual investor is not knowledgeable enough or sophisticated investor, he can himself or she can herself grants overall responsibility to the wealth manager to manage or to uh, oversee his or her portfolio wholly. You probably have learned about the discretionary portfolio management from the asset management company product, one of the most common product, and they are trying to popularize this product, discretionary portfolio management. Okay, so what is discretionary portfolio management? The thing is that you have given the discretion wholly to the wealth manager to manage your portfolio. That means you will not intervene. Who are you? You are the private client. You will not intervene how the wealth manager is managing your portfolio. You just have set your objective, you just have set your constraint, and you just have shared your preferences. And the discussion of managing your portfolio is wholly with the wealth manager himself or herself. But in case of institutional client, for example, I have given you the example of endowment fund set by our department or constructed by our department. There are several committees. It is not like that the department will give that discretion wholly to the particular asset manager that you manage our endowment portfolio. Rather, there will have some committee. For example, there will have a board of directors committee. There will have a committee of investment committee. So they will make decision and they will share their changes in policy, and they will check and balance periodically or frequently to the investment made by the asset manager for the endowment fund. So in case of institutional client, the governance structure is more strict and more sophisticated. So you need to address when you will deal with the institutional client. You need to have a very clear governance guideline that how this portfolio will be managed or how this portfolio will be checked or monitored by the designated investment committee. And in terms of investment sophistication, you can easily realize that in case of private client, the degree of sophistication should be or tend to be relatively low relative to the uh, case of institutional client. So most of the time, if it is not a discretionary portfolio of the wealthy investor, and investor has not given the full discretion to the portfolio manager, it is more likely that he will make some emotional investment decision. So what kind of investment decision can be termed as emotional investment decision? Uh, for example, uh, a new startup has come in the country, for example, that is very much risky uh, in terms of their future potentiality, but that is a kind of e-commerce company, and your private client assumes that it will be a very promising investment for future without analyzing the facts and figure. So if private client or you are asset manager, your private client impose yourself that make investment of 30% of my uh, portfolio or wealth in this particular e-commerce company, because I see the startup companies who are engaged in e-commerce business, they are providing a hefty amount of return to the investors. So I feel I will have this, if I have this investment in my portfolio, I will also have a significant return, let's say 100% return after 5 years. Okay. But matter is that in that case, if you are imposed by your client, in that case, you are addressing or you are taking investment decision which is kind of more emotional, because it is not very much possible for you or very easily possible for you to understand all facts and figures, because collecting the data, what ideal investment analysis tells you, that collect data of prior sales, prior return, then prior volatility to estimate the future return, to estimate the future volatility, to estimate the future promising characteristics. It may not be possible in case of this startup investment. One particular reason is that they don't have a long past; they have a very short past, but they may have a very long future. And alternatively, it is not particularly possible to get the data of the startup companies to analyze this. And we are or not we are, I mean the private clients are very tend to listen the success stories of startup companies. But if you collect the figure, out of the 100 startup companies, only 5 to 6 startup companies get success. So we are very likely to get biased only by the success numbers, rather than understanding the success in terms of the percentage, which is very low. Okay, rather we forget this denominator. It is very likely we forget this denominator, and we heavily put concentration on the numerator, that five are successful, and we don't know whether it is 100 or it is 1,000, because it is not possible that you have information of all successful and unsuccessful startups. Okay, it is not theoretically possible or factually possible. So when I say that empirical it is 5% or 6%, it is based on the data collected by the researchers. Okay, so the actual number that the success rate of a startup may be lower than this rate. So it is a particular example that sometimes your client may impose you to have a investment in a particular security, which is the decision may be more kind of emotionally driven. So in case of institutional client, what I already have told you in previous, that there is a good guideline or strict governance. So it is very unlikely that the institutional client will tell you something, or an institutional client will have some kind of policy or some kind of expectation to make investment which is not supported by the facts and figures. So that's a particular difference between the private client and the institutional client. And in terms of regulation, if you like to relate to it with the constraint, regulatory constraint is also one of the major difference between the private client and the institutional client. In general, you can expect that individual portfolio is less regulated compared to the institutional portfolio. In some countries, it is found that the regulatory authority itself is different for the private client and the institutional client. But in case of our country, the Securities Exchange Commission is the sole regulator of the investment advisors who advise the individual or private clients and who also advise the institutional client. They are regulated by a single authority in our country. And it can be easily understood by you that in case of uh, private individual or private investors, and if you try to relate with the utility learning from your previous session, uh, why the utility function is distinctive for each and every individual of investor, each and every individuals, because of the diverse set of objective, diverse set of consideration, diverse set of constraints, diverse set of their preferences. So, in case of private client, you may find that their uh, portfolio is very much unique, because they have diverse preferences. In addition to their unique preferences, unique profile, their policy is likely to be influenced by some external factors or by some of their own personal factor. For example, a particular client between A and B, a particular client A is a person who has accumulated wealth from his own job, or from his good amount of income from his job. Uh, you, B may have similar amount of financial wealth, but B has accumulated this amount of same wealth not from his job, but from his father, or from his by in terms of inheritance. Okay, so between A and B, you can get a characteristic that when B has inherited property from his father or grandfather, it is likely that he will be more risk taking compared to A. Why? Because A has accumulated his wealth by himself. So it will be very much painful for A for the similar amount of loss, given that all other characteristics are same between A and B. So these are uh, particular facts you need to address. And between A and B, it may be such that A is a client who has investment experience in financial market for 20 years, but B has investment experience for particularly only for 2 years. In that case, though they have a similar amount of wealth, for example, uh, because of their diversity in their experiences, you will find that their portfolio composition differ. Their portfolio composition will differ. But in case of institutional client, though they are also diverse in terms of their objective, but their diversity are not too much or too many, so that it is not very likely that institutional client portfolio is very unique, or in case of institutional client, it is not very diverse, or you may find similarities between, for example, if I try to give you example, if you try to see the endowment fund of University of Dhaka, or endowment fund of, for example, another university, it is not very likely that you will see that their structure is or their portfolio composition or their objectives or their preferences or their strategies are significantly different. It is not very likely. So if I try to ask or try to show you a particular case from the reading, can anyone tell me why uh, the investor, not the investor, asset manager has not given the recommendation of making investment in hedge fund and private equity to this particular client, Garrett Jones? Please read this excerpt from the reading and just tell me 1 or 2 points what you think for this kind of recommendation, or what kind of recommendation you will make if you are an asset manager.
স্যার ওনার বয়স তো 74 বছর, আর উনি
হুম।
তাড়াতাড়ি টাকাটা রিকভার করে নিতে চাবে এই জন্য। আর এখানে তো হেজ ফান্ড এগুলো একটু রিস্কি ফান্ড, হেজ ফান্ডে তো টাকা 3 বছর আগে তোলা যাবে না, এসব কারণে হেজ ফান্ড আর প্রাইভেট ইকুইটি না দিয়ে উনি মোটামুটি লেস রিস্কি ফান্ডে যাবে।
Okay, very good observation. Any other? Any other opinion, or you agree with what is already said? So the points what already have been identified are particularly very specific, that his age profile, and he's already in a in case of personal portfolio, there is diversity, there's a difference. He is also a member of investment committee. So it is very likely that when you are a member of investment committee and you have access to the information that how this endowment portfolio is composed. So as it is an institutional fund, it is likely, what I like to add here, that people try to follow the institutional investment. Because why people are likely to follow the institutional investment? For example, if you look at right now, what is the investment of public, sponsor, institutional, and foreign? I think you are aware of this category available in DSC for a particular stock. So how much percentage of the stock is held by this particular category of investors? If it is such that, for example, let's say sponsor holds, in case of Break Bank, I'm not taking Break Bank, I'm taking here Square. For example, I'm just giving you some arbitrary number. A sponsor holds 50% of a Square stock. Institutional hold 20%, foreigners hold 15%, and public investor held 15%. So it is 100%. It is, for example, the 2019 December 31 figure. If it is such that in 2020, for example, September 30 information may be available to you right now. If it is such that a sponsor is still 50, but institutional are now holding 30%, and foreigners are still 15. And what about the public? Public is
5%.
5%. There is a good signal of making investment. Just try to understand that it is a particular practice in the financial market or the equity market in particular. If I like to specify that if it is found that institutional investors has increased their investment in a particular stock, it indicates that the promising feature or the future payoff or the it is now right time to make investment in Square, because the investment strategy and analysis decision of institutional investor is always sophisticated and is always facts driven, not emotional driven. So when they have increased their proportion of making investment, it is likely that retail investors try to see this percentage, whether institutional investors has increased their proportion of making investment in this particular stock. So in that case, investors are likely to buy this stock when they see the institutional presence in this particular stock has grown. And if just the opposite happens, public gets a negative signal of making investment in Square. What I have said, it is not a kind of fundamental analysis. It is a kind of analyzing the market data. You can relate it with the technical analysis. Okay, it is not a kind of fundamental because you don't have any other information. You just have looking at the market data, and you try to think at how the composition of the investment shift from one particular period to recent period. So what are the reason of relying on the institutional investors? One of the reasons is that they are not the emotional driven investors. Always they make it is likely that they always make the rational investment. Rational means what I already made clear in previous session. They analyze all facts and figure, and that is the reason why Garrett Jones is trying to include hedge fund and private equity in his personal portfolio by seeing that this investment have been included in the endowment portfolio. Have you got the point? What may be his motivation?
Yes, sir.
Okay. So matter is that, but the risk tolerance of Garrett Jones as a private client and the risk tolerance of endowment fund or institutional client in general are not the same. They are different, what you already have learned from the previous. Okay. So that is one of the reasons why you should not recommend a particular investment, kind of hedge fund or private equity to the Garrett Jones, because of the differences in their characteristics. So you are probably familiar with the term KYC, right?
Yes, sir. Know your customer.
Know your customer. So here we will try to put our concentration on understanding our client. Usually, when the dealings are kind of financial in nature, not in terms of product or service, but in terms of financial, we try to identify our customer as client. Okay. But in case of product and service, we don't tell customer as client, but these are Uh,
Sir, I have a question. Like, in previous user said যে ইনস্টিটিউশনাল ইনভেস্টররা যদি কম হয় তাহলে সেখানে ইনভেস্ট করা উচিত, কারণ তারা অনেক প্রিসাইজলি ডিসিশন নেয়, অনেক ইয়ে আছে। কিন্তু স্যার এটা আসলে আহ, মানে ইন জেনারেল না হয়ে এটা মনে হয় কিছুটা ইন্ডাস্ট্রির সাথে রিলেটেড না? যদি ইন্ডাস্ট্রি, কারণ সব ইন্ডাস্ট্রিতে তো আর সেম টাইপের না। লাইক আপনি যদি মিউচুয়াল ফান্ডের কথা চিন্তা করেন, তো মিউচুয়াল ফান্ডের অলমোস্ট ডিরেক্টরদের কাছে 70% মতো অনেক মিউচুয়াল ফান্ডের আছে। তো ইনস্টিটিউশনাল ইনভেস্টরদের কাছে 75% মতো মানে
No,
মার্কেট শেয়ার।
what I have said, that is not applicable when the institutional or sponsor are holding a particular percentage just for regulation. When I have shared the percentage, I assume that the percentage are not restricted or are not the regulated percentage. Rather, they are investing by themselves by making analysis. Okay, in case of mutual fund, there is a restriction that how much percentage should be held by a sponsor. And in case of bank, there are restrictions that how much a sponsor should held of their bank share to have their directorship. Got it?
Yes, sir.
Okay. So in personal information, you need to make in first meeting, usually you receive call from your client. It is not common that you make call to your client. Rather, it is common that your client makes call to you after seeing the profile of your company, your management, or getting recommendation from his or her friends. So when you will have an introductory meeting, you will try to get some information, or by having a physical meeting. As the asset manager or portfolio manager, you try to know this kind of personal information at the very beginning. Okay. So you may ask why these are essential, these are very personal, how these are relevant for making portfolio decision for individual or private client. The answer is that between a person who is married and who is unmarried, do you expect their risk tolerance vary? Do you expect that between married individual and unmarried individual risk tolerance varies?
No, sir.
No?
It's a gut feeling, no.
Gut feeling, no. Okay. When the person is married, it is not such that I'm trying to tell about something, this unmarried person who will be marrying after 2 years. I'm not telling about that person. I'm telling about a person, for example, 40 years, two person, this person is married and this person will not marry, or this person will lead a single life. Okay. This person has a number of family commitment. This person does not have a number of family commitment. So when the person has a family commitment, I mean he has a commitment to meet up his family expenditures regularly, to meet up the expenses for his children's education. Obviously, you need to expect that the risk tolerance is to be relatively lower for this person compared to the unmarried person who does not have this kind of commitment. Rather, he tries to he tries to spend money only for himself or herself. He can manage his or her life. But here, the individual's life is, or individual's income or individual wealth is related to the well-being with a number of his or her family members. What do you expect now? Whether
Sir,
your gut feeling changes or it does not change?
yes, sir, it changes. So married person will be less risk tolerant.
Married person will have less risk tolerance. Okay, so that's why you need to have this kind of information. And you also need to have a kind of career information between uh, this different type of client. Okay, these different types of client. What are the reason? For example, a client, if I like to give you an example, a client, for example, in a very in his initial age of career, for example, 30, and a person who is in a very matured stage in his career. Now, can you tell me, this person who is in his early career life, he will have more more borrowing need or liquidity need from his portfolio, or this person will have more liquidity need from his or her portfolio? Who will have more borrowing tendency?
So the first person
The first person.
will be.
So it is related to that where you probably have learned more about it from your investment analysis, from the learning of investors' life cycle. Okay, that is related to that learning also. And you need to assess the source of client's wealth, because I already have shown you an example that when a person inherits wealth from his or her father, and when a person has similar amount of wealth from his own income, their perception, their preferences will not be similar. Their preferences will vary. Okay. So this kind of information or personal information you need to pick from your private client. And in terms of financial information, it is not very easy to have the financial information from your private client, but in case of institutional client, it is not much difficult. It is easy to get, because there is a governance, there is a reporting system in case of institutional client. So you get information by statement of financial position in general, balance sheet, or you can also look at the income statement or comprehensive income, or you can also look at the cash flow statement. But here we try to identify the private balance sheet, not the institutional or company or business balance sheet. Okay. So how many of you have your own balance sheet, or you have a mental picture of your personal balance sheet? I don't ask for a hard form of your balance sheet. Or you have a very good idea of your father's balance sheet, that what kind of asset your father holds, or what kind of liabilities your father holds. How many of do you have this kind of information from your father or from your mother?
Sir, কিছু কিছু জানি হালকা পাতলা।
কিছু কিছু।
Sir, yes, sir.
Any other response?
I have picture of my own balance sheet.
You have picture of my own balance, your own balance sheet.
Yes, sir.
Okay. Can you tell me about some of your liabilities?
Sir, yes, sir. I owe a particular amount to one of my relatives.
How much that is?
Six,
If it is not a personal question.
no, 6,000.
6,000. Then
And sir, nothing else.
any other?
No liabilities.
Okay. Okay. Any other person want to add to the responses already received? Okay.
স্যার আমার পার্সোনাল ব্যালেন্স শিটে স্যার ইনভেস্টমেন্ট আছে স্যার 2 লাখের মতো পার্সোনাল ব্যালেন্স শিটে ইনভেস্টমেন্ট ইন ইন্টারেস্ট বেয়ারিং বন্ড 2 লাখের মতো
Okay. Can I get a response from a female student or female participant here? I just like to make a balance that I have got responses from two, and I like to add response that what I like to see that you are aware of your own balance sheet or your parents' balance sheet. So if you're not aware of your own or your parents' balance sheet, it is unlikely that you can understand your client's balance sheet. That what kind of asset that a personal balance sheet may held, or what kind of liabilities a personal balance sheet may show. Okay. For example, it is not likely that if you have a life insurance, that is a kind of asset that you will have a benefit from this. It is not likely that you see this kind of asset in personal balance sheet or personal asset. But in case of institutional, you don't expect or you don't expect this kind of asset. And if I like to add another example that you are very likely to see plant and equipment, property, plant and equipment or PPE as a common item in the balance sheet of company or the business. It is not likely that you will see this PPE in case of personal balance sheet. No response.
স্যার পার্সোনাল ব্যালেন্স শিটে পিপি এর মধ্যে আমাদের প্রপার্টিটা থাকতে পারে না?
Yeah, but that is not the term what has been defined in the IFRS for PPE. That can be your real estate.
Okay,
I think you don't have your personal plan. If you have a plan that is particularly for a business, it may be a kind of sole proprietorship business, but that is not your asset. Rather, you are very likely to show that as an asset of your company, which is individually held. Okay.
Yes,
We also have some official equipment, or we also have some personal equipment. Okay. But that is not particularly covered how the IFRS has defined the not IFRS or the other financial standards define the PPE. So I try to give the example from the definition of PPE. Okay.
স্যার
Obvious.
যদি
Yeah.
পার্সোনাল ইন্ডিভিজুয়াল ক্লায়েন্ট কোনো বিল্ডিং অথবা কোনো ফ্ল্যাট পজেস করে থাকে তাহলে আমরা সেটাকে কোন ক্যাটাগরিতে ফেলবো?
Of course, it can be kind of land property or building property or real property, you can say.
ওকে স্যার।
Okay. There is no particular standard. When I try to tell you that picturize the personal balance sheet or personal cash flow statement, you are not obliged to follow the financial standards strictly. Rather, you will try to categorize those items in terms of the category which is commonly understood by the readers or which is understood by the people around you. Okay. So let me show you my personal balance sheet. If you are aware that or you have not forgotten the learning from your business taxation course, you can recall that one of the attachment need to be attached to the income tax return is the statement of assets, liabilities, and expenses. Can you recall?
Yes, sir.
Okay. So for that purpose, I need to prepare my personal balance sheet. So in terms of the structure given by the income tax authority, I have prepared my personal balance sheet. So you can expect that I have a share in a non-agricultural property. So that is a wide array or plethora of properties which are non-agricultural. So I'm not specifying which property it is or what kind of property it is. And I have included my financial assets in terms of two categories. I have some investment in shares and some mutual funds. Now, of those values are here. What kind of values I'm presenting here? It is the cost value or historical cost or the market value.
So market value.
Market value, but it is the there is a regulation from the financial reporting standards that what kind of investment are to be reported in market value in general, which are held for sale, which are available for sale, that are actually or represented in market value. Otherwise, those are represented in historical value. Okay. So here I'm presenting my numbers in historical cost. If I would present this number in market value, the number would be lower from this amount. Okay. This is my DPS out in the category of financial asset. I don't have motor car. I have a gold ring, 12,000. Some furnitures, equipment or electronic item. You see the personal, you would see this kind of assets in company balance sheet in the name of PPE. Okay. Then other assets of significant value, I have included the value 60,500, and I have this amount of cash balances in terms of this, and this is my gross wealth. Approximately how much? 2 million taka.
Yes, sir. Close to 2 million.
Okay, so I'm not a person to pay the wealth tax, which is applicable for the people who have property more than 2.5 crore. Now it was 2.25 crore when you are reading the business taxation. And I have some liabilities, and this is my net wealth. Okay. So what I like to stress that when you see the personal balance sheet or when you picturize, it is not the thinking of making picture. Rather, you need to write down your client's asset and client's liabilities to have an idea that what kind of client you are dealing with. If it is like that, you are dealing with a client who has a significant amount of liability because he has taken multiple credit card loan, and he has taken car loan, he has taken residential loan, compared to a client who has not taken this kind of liabilities, which client will have more liquidity need? Or which client will have more risk tolerance? The first one or the second one? You are there with me?
Yes, sir. So question to repeat করবেন.
Between two clients you are dealing, one client has a plethora of many loans. Okay, many loans. I just try to give you some example, like for example, he has automobile loan, he has a mortgage, he has a car loan, he has taken loan in his brokerage account. And you are dealing with another client who does not have this loan. For example, one of you has mentioned that he has loan only of 6,000. Okay, so between these two clients, who will have more risk tolerance, and who will have less liquidity need?
So more risk tolerant হবে যার এসব লোন নেই এবং তার লিকুইডিটি নিড হবে কম, যেহেতু তার রিস্ক নেই, তার লায়াবিলিটি পরিশোধ করতে হবে না, তার জন্য তার লিকুইডিটি নিড হবে কম.
Okay, so that is the case. And another thing, you need to relate this also with the cash flow statement. If you have the cash flow statement, that how your cash inflows come in, you mean you are a client. Okay, and asset manager, when he or she has an idea that how his client receives cash inflow and how cash outflow occurs for his or her client, it will be easier for him or her to design or to set out how the portfolio will be constructed. If the person or if a family has the amount of wealth which is much greater than the monthly cash flow or annual cash flow needed by that family, in that case you may be more you means you are an asset manager. You may feel more comfortable to make investment in longer term horizon investment for that family who has more wealth compared to their annual cash flow need. Okay, so this is an example of the private client's personal balance sheet, and you will try to identify what kind of assets and what kind of liabilities a typical private client may hold. Okay, and in case of in terms of tax consideration, what you need to understand, the tax profile of the private client you are dealing with. Matter is that there is a good amount of differences in terms of tax based on the tax jurisdiction in which the client lives. So just try to make some high-level remarks, like you are very familiar with this kind of taxes from your tax course, that the taxes are applicable for income, wealth, or for making consumption in some particular fields. But matter is that what can you do? You will have an objective to reduce the tax liability of your client. So it is a complex task. So you need to see that what kind of tax profile your client has or our client has. So some particular strategies you already have learned, some strategies from your tax course. For example, tax avoidance. It is possible if you invest in tax exempt securities for your client. It is possible, or it is also possible to avoid taxes. In some cases, in our country, there is no taxes on wealth transfer. I mean, you transfer wealth or father transfers wealth from his ownership to his or her his daughters, her sons or daughters title, there is no taxes on this transfer in our country. But in other countries, or particularly in developed countries, there is a wealth transfer tax. So in some ways, it is possible that if you transfer in some accounts in this way, or some of these individuals, you can avoid, or you will not have the tax liability. And tax reduction, it is also possible to reduce tax by taking the opportunity from the tax loss. And it is also possible by reducing taxes. For example, if it is found that uh, a dividend gain has lower taxes relative to capital gain, so you can make a plan in such a way so that you will have a similar amount of cash flow, but you want to generate the cash flow in terms of dividend gain by avoiding the capital gain. Why you are avoiding the capital gain? Because you want to avoid the capital gain, or you want to avoid the capital gain by reducing the turnover. So by reducing the turnover, you try to reduce the capital gain, and you reduce the tax liability from the which arise from the capital gain. So you need to look for the opportunities. How can you reduce the tax liability? So there was a time when the tax rate in dividend and the tax rate from capital gain used to differ. However, gradually, the differences between the dividend tax rate and the capital gain tax rate is gradually shrinking. So authority has identified that how people are using the loopholes between the gap of the tax of dividend gain and the capital gain. And if you are not unfamiliar with the proposition, you can understand that there will be no differences whether a stock pays dividend or not pays dividend, because it is possible for investors to make a homemade dividend by selling capital gain. Okay, so by selling the asset and to realize the that amount of dividend what he or she was expecting. So that is the way how portfolio manager needs to address to reduce the tax. And it is alternatively, it is also possible to defer the tax so that you can utilize the learning what you have learned from the time value of money. So rather than realizing the capital gain early of your age, when you have a higher income, higher marginal tax rate, you try to defer your capital gain for till your retirement, so that you will have less income when you are in retirement, and you will have lower marginal tax rate, so that when you will realize capital gain in that age, you will have reduced tax liability. So how you are using that benefit? By deferring your the transaction which would generate the tax liability. So you will try to look at the example, and you will try to identify from our just finished discussion that how what are the strategies of or which strategy looks like the tax avoidance, which strategy looks like the tax deferral, or which strategy looks like the combination of both tax avoidance, tax deferral. So you'll try to look at that example. And other than this information, what we already have learned that are essential to know, you also need to understand that, or you need to collect some information that which are related to the planning what you are making. For example, your client, private client, has given you the responsibility of also oversee his estate planning. So I don't know whether you are familiar with estate planning. In brief sense, it is the planning the individual make uh, in order to design that how his or her wealth will be allocated or distributed after when he will be absent or after his death. Okay, so you need to collect the document or you need to collect the information related to this from your client, that how he wants to allocate his asset or how he wants to plan to distribute his assets when he will not live, okay, or when he will not alive. And you also need to uh, collect the information which is which will guide you to make the decision. For example, you have a private client account which is held by a couple. So the husband and wife are jointly holding this account, what you are managing. So you need to specify who will be the contact person or who will make the decision. If it is such that wife will govern the decision or wife decision or wife is the first person of whom the decision will be the final or of whom the decision will be the taken by the asset manager, you need to specify at very beginning. So related to this, if I just ask you from a behavioral finance perspective, uh, that which one is more safer? Okay. One of the behavioral bias of investors are overconfidence. One of the very common. So it is not like that you expect that the a very hefty percentage of return. It is not like that. Overconfidence does not mean that someone is expecting 50% return, but the reality is that the return shall be 20%. It is not like that a person is expecting that 50% return will be available from this particular investment when other people are thinking it is 20%. It is not overconfidence. Be very precise, okay? Rather, what is overconfidence? If it is it is found that the volatility of Grameenphone is, for example, 10%, but this is the objective assessment that you have collected the return and you have estimated the monthly volatility standard deviation, and you have found that the standard deviation of volatility of Grameenphone is right now, annual volatility is 10%. If it is such that for subjective weakness or for your emotional attachment to the Grameenphone as you are subscriber or someone of you or some of your family members work in Grameenphone, you expect that the return of Grameenphone from the stock market will have the future volatility of 6%. In that case, you are overconfident. Have you got it? How you will understand the overconfidence? In terms of measuring the risk, not in terms of measuring the return. So when you are underestimating the risk, you are overconfident. When you are underestimating the risk, underestimate from what? Underestimate from the objective assessment. This is the objective assessment. But you like to believe that this is to be 6%. In that case, you are overconfident. Have you got it? I just
Sir,
like to make a question here.
স্যার এটা কেন শুধুমাত্র রিস্কের ক্ষেত্রে স্যার, যেটা হচ্ছে অবজেক্টিভ অথবা জেনারেল কনসেনসাস সেটা থেকে যদি ডেভিয়েট করে কেউ, তাহলে সে ওভার কনফিডেন্ট বলা যায় না?
In this case, if he underestimate the risk, in that case, overconfident. If it is like that, you are a person who is thinking that it should be 16%, you are underconfident. Have you got it?
Yes, sir.
Okay.
Yes.
Now tell me, what is your perception by analyzing the characteristics of your father and mother? Who is more overconfident between father and mother? That will vary, but I just like to get the general consensus among you.
So usually mothers are a bit overconfident.
Mothers are overconfident.
So slightly.
Slightly. Okay. Then, any other response? I don't know whether other people don't like to tell anything, or they feel it very cumbersome to unmute their voice.
I think my father.
Your father is overconfident. Okay. Any other?
Yes, sir, father.
Father. Okay.
Yes.
In empirical research, it is found that, forget about father and mother, males are overconfident compared to female. In empirical research related to the overconfidence, it is found that between male traders and female traders, male investors and female investors, it has been found that female investors are more likely to be underconfident, and male investors are likely to be more overconfident. Not more overconfident, the term is overconfident, are likely to be overconfident. So how can you understand that, or how researchers identify that a person is overconfident? Okay. So I just like to add one point. I will not explain that in detail because our point is different here. If it is found that a particular account has more trading, you know, the trading, more buy and sell in a particular BU account, for example, very plain example. Okay. It is found that average trading in female is lower compared to the average male. Male are likely to trade more and more in their account compared to the female. So based on that, it has been concluded that males are more overconfident than female. Okay. Don't try to relate it with some other personal decision which are not financial. What I'm trying to mean here in terms of financial. So what I like to tell you, so from this research, it is recommended that, or not it is recommended, it is generally believed that female make good financial decisions relative to male. Because you need to believe that overconfident people, except some circumstance, overconfident people don't make the right decision in long run. Okay, there is a different findings for different contexts, but from financial perspective, as it is a behavioral bias, it is found that the overconfident investors don't make good return in long run. Okay, so who make good return? Who are not overconfident? Let me make it very precise. I'm not highlighting that you need to be underconfident. Overconfident is as harmful as underconfidence. Okay, you need to be confident with the objective assessment or with the rational number, not with the irrational number. Okay. So what I like to tell you that if a couple, female and male, has a joint account, they have their private wealth manager for the long run well-being of this account. What you will try to tell about who shall be the contact person between female and male in a couple when they will deal with the wealth manager, or they will guide the wealth manager.
So the female.
The female should be recommended. Okay, that is a kind of general remark. There is a kind of general remark from just some plain example or some research findings, but it is not the recommended from the investment community what I just have made. Okay, I'm just telling you that as female are less overconfident compared to the male, that's why it is safe to assign female to deal with the wealth manager regarding making investment decisions. Okay. From my own experience, my father is overconfident related to my mother. Okay. And in my personal life, I'm more overconfident. Not I'm more overconfident. I'm overconfident compared to my spouse. Okay. So that's why I make more trading in my portfolio account related to the trading made by my spouse in her own account. And in addition to this, if your client expects more service compared to the standard service what you provide, for example, you provide as a wealth manager, you provide a monthly statement, not weekly. But your client expects that you update the portfolio value to your client every week or every 3 days interval. In that case, that is very specific relative to the standard practice you do. So you need to have that information, what kind of a specific requirements your client asks from you. Okay. And the client goal, we need to identify what kind of goals or objectives for this financial or the portfolio management course. We will not make difference between objectives and goals, though you have learned a good number of differences from your other strategic management course or your marketing course or your other courses. But for portfolio management, investment analysis, these courses, we don't make any difference between the goals and objective. So what we like to make the points here that client goals are sometimes very objective, very precise, very easily identifiable. In that case, those goals are planned goal, but in some cases, the goals are in place, but the goals cannot be objectively or precisely identified. In that case, those goals, we try to term those goals as unplanned goal. So there are some planned goals before you. What kind of planned goals? This is the number one for each and every individual. That is how he like to lead his or her life after his retirement. Okay, so he likes to have a specific amount of cash flow. This amount he likes to share this number to his or her wealth manager. So that is a good example of planned goal. But in case of unplanned goal, for some medical emergencies, it may be such that in developed countries, for example, when I visited UK, all of my medical expenses are borne by the insurance covered by the UK government. And though I had to pay a lump sum amount for the health insurance, but it is not likely that all of the medical expenses can be covered in the health insurance. In some cases, for example, a client have a big disease or, for example, cancer. In that case, it may be such that the insurance does not cover these expenses related to cancer. So this goal, that this kind of medical emergency, you need wealth manager need to have some idea that what kind of medical expenses, unplanned medical expenses may arise for my client. Okay. So some concepts are essential that related to goal. That is that you need to try that it is possible to quantify the goal. So when the goals are not quantified, it becomes difficult for wealth manager to design the appropriate portfolio. Okay. So if the goals are mostly these goals identified by or suggested by the client, in that case, it is easier for you. But if your client particularly focuses on this kind of goals, when these goals are not precisely identified or it is not very objectively measurable, in that case, it becomes difficult for wealth manager. But in general remark, wealth manager needs to try to quantify the planned and unplanned goal as much as possible before making or beginning the construction of portfolio. Okay. Then some goals are more important than other goals. For example, a particular private client, the goal of meeting the client's children educational expenses may be more important than meeting the expenses for family events. So you need to ask from your client that which goals you prioritize among the goals you have mentioned. So across the time, there may be the situation that goals are changing. So when client changes their goal, you need to get update from your client that whether your goals remain constant, what you mentioned initially to me, or I need to review the goals so that I can review the portfolio what I already have made. Okay, we already have got the concept from risk aversion and risk tolerance from our previous learning. But related to that, some concepts are essential to precisely understand your client, because sometimes some related concepts are commonly termed as risk tolerance, but those are not risk tolerance. Okay. When we say risk aversion, we know that how much risk that an individual is willing to avoid, and individuals are very likely to avoid the risk, and risk tolerance is just the opposite of risk aversion. And in previous session, I tried to show you that average individual gets more utility from the less riskier or risk-free same outcome. That's why individual can be termed as risk averse. But if your client is a risk lover or risk taker, in that case, the objective or the utility function will be just the opposite. But what I try to add here, that is the opposite term of risk aversion is risk tolerance. Okay, so what you will say that how much amount of financial risk an individual investor is willing to take. Okay, but matter is that an individual, for example, you may ask that how much loss I can bear. If you are not an attendee of the Google Classroom, you have probably seen that in March 18, 2020, my portfolio has lost more than 200,000. So I didn't have though I felt bad, but I was not mentally depressed of having this amount of losses in my portfolio. Okay, that means you can say that, or I can say that I have a risk tolerance of this amount, 200,000, or between 200,000 to 300,000. But if it is such that uh, I, I have I have portfolio of I had portfolio of around 1 million. But if I have portfolio of only 500,000, for example, and this is a significant portion of my wealth also, total wealth, for example, in that case, my ability to take the risk would be lower. Okay. So in terms of risk capacity, what we try to mean in this risk tolerance, we try to focus on the willingness, not on the real capacity. We try to focus on the willingness. But when we term the capacity, we try to objectively measure that how much ability this individual has to accept the financial risk of this amount. Okay, how much ability? If I have, for example, my total wealth is 200,000, obviously it is not possible for me to tolerate this amount or to capable of tolerating this amount of risk. So how much my financial ability support to accept the risk, that is my risk capacity. That is more objective measurement compared to the risk tolerance. In case of risk perception, which is related to, we just have discussed regarding the overconfidence. When your subjective, what is your subjective assessment of the risk you measure for a particular investment decision? Okay, so for a Grameen Fund return, for example, you expect that you will have 100,000 risk or 100,000 risk in terms of number, or not in terms of percentage. Okay, or in terms of percentage, for example, it is 10% of your investment in Grameen Fund, you can absorb this loss of 10%, or it is kind of, for example, your objective assessment based on your other profile. But if it is such that you expect that Grameen Fund investment will cost you approximately this amount of risk, double of the objective assessment. In that case, this is your perception, subjective assessment, not the objective. Objective is 100,000, but you subjectively, or you are underconfident. You are underconfident. That's why you expect more losses from the Grameen Fund investment. So in that case, when you are concentrating on your subjective assessment of risk, that is the risk perception. Okay. For example, if I just try to give example from your real life, I may, between road accident and the year accident, if you objectively measure, the percentage is much higher here, much higher. The risk is much higher here to use the roadway. However, subjectively, people feel that the risk of air traveling in air is more risky. So that is kind of subjective. But objectively, the risk is very low in air transport or air traveling. So you are familiar with the kind of risk tolerance questionnaire from your investment analysis course. These are some kind of questions you may ask from your client, that how much potential decline in your portfolio you may absorb, but this should be familiar from your investment analysis course. But what I try to remark on this, that is, it is found that in academic studies, the how these kind of questions are more subjective, not much objective. That means you as an asset manager are more likely to subjectively design this risk assessment questionnaire or risk tolerance questionnaire rather quantifying it objectively. And if it is found that how the question is structured or how the question is made influences the response of client. If the question is from the return perspective, or if the question is from risk perspective, it is found that when the same question is asked from the return perspective, when the question is asked from the risk perspective, just by changing the words, it is found that the clients is picking different option. However, what it should be, however the question is explained, obviously the option should be same. Option should be same in which way the question is structured. But it is found that the structure, how the question is designed or how the question is asked to the clients influences the response of the clients. Okay, so you need to be careful of these issues. And I like to conclude our today's discussion just highlighting some points related to the skills which are required for you to have if you like to pursue as a wealth manager or asset manager. You may feel that I will not be the asset manager, I will work for the government. Rather, I will assign the task of managing my wealth to a person or to a professional manager. So the matter is that if you don't know what characteristics or what skills an asset manager should have, it is very likely that you will end up picking an asset manager who does not have a good combination of skill. So whatever the career you will pursue, it is not likely that you will not have wealth. Obviously, you will have wealth. Your wealth will gradually grow over time. When I was a student like you, I had my net gross wealth, what I showed you right now, close to 2 million. It was around 50,000 taka when I was a student like you. I was in your own age. So I graduated in 2014. So now it has been approximately 6 years. So within 6 years, I started making investment in 2010 when I was a sophomore. So in that time, I had a wealth approximately 10,000 to 20,000, but now it has grown. So unless you have the skills yourself, or you know the skills required to have with the asset manager, it will be very likely to pick a wrong asset manager for managing your wealth. Okay, so it is a common complaint among the private clients in market that their asset managers are not doing well for their portfolio, and they are losing their portfolio value every month or every year. So what may be the potential reason? They may have bought their fund, or they may have picked their asset manager without assessing the skills of the asset manager. Okay, so what kind of skills an asset manager need to have? First of all, some skills are very technical skills, what you are learning from the finance degree or BBA in finance. I'll show you. And some soft skills, what you need to practice or you need to learn from your communication or from your most related to your extracurricular activities or out of your communication skills. So for example, Out of the technical skills, just let me just try to make note on 2 points. Capital markets proficiency. You need to have plenty of knowledge that what kind of assets in a particular financial market exist, and what are their characteristics and how they are performing, and what kind of assets you will try to pick for your client. It is not likely that you know very well only for equities. You don't know what is about the real estate. You don't know what is about the startup investment. You don't know what is happening to the forex investment. So you need to have a good idea of all asset classes and the assets within that asset classes. For example, in equity asset class, if we are asked that how much you know about the Grameen Fund, I may tell you something, or an asset manager can tell you something for 5 minutes or 10 minutes. But if you ask asset manager to tell something about Zil Bangla or JMI Shirins, or you like to ask about something, for example, a company which is not commonly known but may have a very good investment, because you know from farmer friends that the stocks which are not growth stock or value stock, growth stock are kind of a stock which are very attractive, which have caught attention of the investors. It is likely that they will not outperform in future, rather which will outperform the opposite, which are not blue chip stock. The stocks which are a small stock are likely to underperform. But in asset manager, it is very likely that they know very well, they devoted all of their knowledge to learn about the assets which are large cap stock, which are not a small cap stock. So in that case, you are losing opportunity of making return from the small cap stock, which has been identified by the academic research. Okay. Then another technical skill I like to highlight, for example, technical skill. In portfolio management, you will see some application of Excel, that how to use the solver to optimize the portfolio and to get the number that how much how much percentage I need to allocate, for example, for real estate, for equity, for bond, for forex, to have a 10% return, or to have a 5% risk every year. Okay. So when you will use the solver, you will get what kind of percentage the portfolio optimization software is asking you to make investment. So how to analyze the data and how to make the data analyzable, this kind of skills you need to learn as a portfolio manager or as an asset manager. And I told you that about robotics, okay, that robo advisory service. So these are highly machine learning equipment involved. So gradually you need to learn that how machine analyzes the high trading frequency data to give the quick decision to the clients, okay? And the language fluency. So it is not likely that if you have your fluency only in native language, you don't have fluency in other languages. When you will be a global asset manager, or if you are a local asset manager also, you need to be very comfortable with the language in which your client speak. Okay, your clients speak. So you need to, it is also a technical skill. In terms of soft skill, I just like to make a high level remark as our time has elapsed. That is, for example, my fund has, or my portfolio has incurred, for example, 30% loss. So the matter is that how I will communicate this loss to my client. If it is such that you just like to tell that the market is not going well, That's why I have incurred this 30% loss in your portfolio. Rather, you need to be more empathy. You need to have a more empathy. That means you need to feel that it is not loss of your client portfolio, it is loss of your own personal also. Okay, you need to feel that the feeling what a client will have, you will speak to your client in a way that you have a same sympathy, or you have the same empathy like your client, or you have the same feeling like what your client is feeling. But in most of the cases, it is found that the when market goes up, when market goes up, asset managers or portfolio managers communicate much with the client that we are doing very well for your portfolio, we are doing best for your portfolio, it was a very good decision to make investment with us. This kind of a statement, this kind of email you are very likely to get from your manager as a private client. But in opposite situation, for example, when the market was not going well in this earlier of this year's 2020, or when the COVID started, it is very unlikely that you will get some mail which expresses empathy to you by the asset managers, that what kind of potential reasons that the portfolio value is declining, and what kind of attentions we are trying to make, and what kind of protections we are trying to make for our investors. Okay, so you need to have some soft skills, obviously. And how can you develop? You can develop by expressing, or by you can develop these skills by improving your communication skill, by improving your social skill, by having good friends, and by having a good negotiation skill. And you also look at that how salesperson sell the product by convincing the customer. And as a wealth manager, if you don't convince, or if you don't have the convincing power, but you have a plenty of knowledge, plenty of technical knowledge, but you don't know how to convince the private clients to make investment with you, it will become difficult to get the fund from the private clients. So you need to have some sell skill so that you will have the fund to be invested with your firm. Okay, so I think it is a very good time, and I already have taken 10 minutes extra from you, and I apologize for that, because it is a serious concern for you to take the extra time